you want to utilize whatever tools you can to have the lowest taxable income possible. But what if it doesn't exceed the standard deduction? What if you live in a state like Tennessee where we don't have state income tax and our property taxes are relatively low compared to the rest of the country? What if you give some money to charities, but it's not 10% of your income? If you're in relatively good health and you didn't have medical expenses, at least to the point that they exceeded 7.5% of your adjusted gross income, and you can't claim any of the expenses that you did have throughout the year. Well, in that case, now we're looking at these things that are available to us. And even if we're a homeowner and we have home mortgage interest and we pay property taxes, it may not be enough for a single taxpayer to exceed $13,000 in the standard deduction. That's over $1,000 a month that you'd have to be paying between those two items. And at $90,000 taxable income, I would argue they're probably not in some home that has a $500,000 mortgage that they just got, where they're paying so much in mortgage interest that they would be able to find enough expenses to exceed that standard deduction. And the ironic thing is that if you're married, because for married couples who file jointly, that standard deduction raises from almost $14,000 to almost $28,000, it's an even higher bar to hit, not just in terms of the expenses associated with your home, mortgage interest, property taxes, and the like, but also your other deductions that you could itemize, where you have to clear that $28,000 bar to justify listing them out, as opposed to just taking the standard option. But you don't have to take my word for it. Let's look at an example. If you're following along on screen, you're looking at something that's called a mortgage amortization schedule calculator. Put more simply, it is a schedule year by year of the amount of principal you would have paid off and the amount of interest you would have paid towards your mortgage over the course of the repayment period. In our example, we have a couple who has a $350,000 mortgage that they take out for 30 years at 6.5% interest, and we can actually look year by year and see how much they've paid in principal and interest. For example, if they started this mortgage in February of 2024, then over the course of the next 12 months, they would have paid down just $3,200 in principal from that original $350,000, and they would have paid $18,880 of interest in the first year. Now, to be clear, that's a significant amount of interest, but if they're going to claim that interest as an itemized deduction on their tax return, remember that they have to have enough other expenses elsewhere in their financial life to justify and clear the standard deduction, which is almost $28,000. So they've got almost $10,000 to go. Now, property taxes will help with that, because remember, you can also deduct property taxes. But like I said, if they don't live in a state that has income taxes, they can't use income taxes. If they're in a position where they don't have medical expenses that exceed 7.5%, they can't claim medical expenses. Maybe they give $100 a month or so to charitable organizations, but there is no guarantee that they have enough other items that they can itemize to clear that standard deduction. And if they can't clear it, let's say that at the end of the day, they end up with only $25,000 of itemized deductions, that means that they would benefit by just not itemizing at all. And if that's the case, they wouldn't receive any of the tax favorability that people talk about when it comes to owning a home. When we get into rental real estate, that's a different story. But when people weigh the pros and cons of renting versus owning, they may say, oh, well, I'm renting for $1,800 a month or $2,000 a month, and my mortgage is going to be $2,100 a month, but I can deduct some of that mortgage interest and I can deduct the property taxes that I pay. And when you look at the fact that I own the home, that's just so much better than throwing money away renting. Possibly. It could be a benefit for other reasons to go ahead and buy a home as compared to continuing to rent. But understand that as that standard deduction goes higher and higher, there's a larger and larger percentage of people in this country for whom it would benefit them to just take the standard deduction. And in that case, them being homeowners becomes irrelevant from a tax perspective. They're simply taking what's available to them, and they're not even utilizing the deduction that's available to the mortgage interest or property taxes that they pay each year.